Good morning, happy Christmas jumper day, and welcome to the Killik & Co market update. The UK has yet to agree a trade deal with the EU, and the prospect of no deal is now looking increasingly likely. The EU has now published its emergency procedures showing how trade can continue in the event of our transition period ending on the 31st of December without a deal in place. We can have a look at the performance of sterling to show that investors believe that the chances of a deal are becoming less and less likely. Here's a chart showing the performance of the pound against the euro over the last 5 years. You can see that back in 2015, £1 would have bought you €1.38. However, that rate plunged in 2016 following the publication of the referendum result, and we also saw further weakness in the pound in March of this year when the global market was falling. That really shows that people do not see the pound as a safe haven, and investors were moving out of pounds in favour of euros when they were concerned about the prospects for the global economy. We've also seen further weakness in the pound over the course of December so far, as the commentary around the negotiations has become more and more negative. That said, it is still possible that we could reach a deal. Politicians have given a deadline of this coming Sunday for a Brexit deal to be reached, so hopefully by this time next week we will have some sort of answer. Earlier this year, the PRA, or the Prudential Regulation Authority, i.e. the banking regulator, essentially forced UK banks to stop paying dividends to their shareholders. The regulator was worried about the economic situation, and it felt that banks should be holding back cash in case of any unexpected expenses, for example, customers defaulting on loans because of the coronavirus. The move came as a huge disappointment to income investors and pension funds, many of whom were holding these banking shares just for the dividends, which in many cases were in the region of 5%. This week, the PRA has released a statement saying it will now allow banks to start making payments again within reason. So let's take a look at some key points from the PRA's statement. On the plus side, the regulator has said that the PRA's assessment is that banks remain well capitalised and able to support the economy. On the slightly more concerning side, it did say that economic uncertainty as a result of the COVID-19 pandemic remains high, and also that considerable uncertainty remains about the new relationship with the EU, to which the UK will need to adapt in the coming months. And the conclusion from the PRA was that an extension of the exceptional and precautionary action taken in March is not necessary, and that there is scope for banks to recommence some distributions should their boards choose to do so. So this is potentially very good news for income investors, and it is a statement of confidence from the regulator in the future of the UK economy. And finally, we've mentioned Walt Disney a few times recently on this video, but we just wanted to touch on the company again because it had its Investor Day yesterday, and the new subscriber figures for Disney Plus are certainly worth a mention. Disney Plus is Disney's new streaming service, which was launched last year, and in its Investor Day 2019, the company said that by the year 2024, it would like to have between 60 and 90 million subscribers to the service. Yesterday, the company announced that it already has 87 million subscribers, so it's hit that target 4 years ahead of schedule, and its new target for 2024 is to have between 230 and 260 million subscribers. So this is a great example of a large company adapting to stay relevant. Moving on to have a look at next week, we've got results out from Nike and Accenture. That's it from us. Enjoy the weekend, and we'll see you next Friday.